All right, good afternoon, everyone. Thank you for coming out today. I'd heard we were going to be standing room only, but no one's standing, so there you go. So we want to go through the overview and reinforce what our long-term strategy has been. There's no particular changes, but just to reestablish how we're approaching things. We at the moment are basically executing the long-term strategy without any significant changes. We believe our portfolio is well positioned for when commodity markets improve. The business has always been cyclical, always will be, and improvements will come at some point. We are benefiting from low oil prices. There was some misconception of that last kind of November, December when the oil price was falling so dramatically. But there's three core reasons why low oil prices are good for us. First, for every dollar a barrel, it's an additional $5 million of EBITDA. Second, to the extent that there's a correlation between oil price and Canadian dollar and it drags down the Canadian dollar, for every penny there, it's an additional $52 million of EBITDA. And of course, third, to be able to build Fort Hills during a period of low oil prices when many of our competitors have significantly cut their CapEx budgets, just makes it that much better environment to control the costs there. We're emphasizing that we are controlling the controllable. There are lots of things within the industry that are beyond our control, and so that just means that we have to have extreme focus on what we can control, which is generally costs. We are building an energy business that we believe for the long term will be a great benefit to our portfolio, and the economics are probably a lot stronger than most people realize. We often see people who just focus on the WTI oil price without looking at the other key components, including exchange rate, and we'll be talking about that a bit more, particularly in Ray's presentations, but I've got a slide as well. And then we obviously want to retain a strong financial position, and we are committed to our investment-grade credit rating, and both S&P and Moody's have given us a stable investment-grade credit rating. Before going on to other strategy slides, I did want to update on management changes during the year. In 2014, we appointed Shehzad Barmel as VP Strategy and Development Copper. Effective March 31st, Shehzad was in Trail for many years, and then we moved him down to Chile for at least 3 years, I guess, and more recently back to Vancouver in his current role, looking at not only other opportunities in the copper industry, but other things that we can do with our current assets in the copper division. Larry Davey was appointed VP Development Coal to succeed Bill Fleming when he retired, again effective March 31st. And Larry also was many years at Trail, and then we had him up at Pogo in Alaska, then back to Elkview, and now in the VP Development Coal role. Andrew Stonkus more recently was appointed Senior Vice President Marketing and Sales. He had been Vice President Base Metals Marketing, and we've decided, we've been thinking about this for 2 or 3 years, but the time came that consolidating our marketing functions under one leadership and really getting the synergies between the 4 streams, if you like, copper, zinc, steel-making coal, and energy, marketing bitumen. It was quite interesting because we had people in coal putting up their hands, interested in wanting to be involved in the bitumen marketing strategy. We need to have our plan in place by the end of 2017, so there's still time. But we've been doing significant things now in terms of putting capacity in place. We've been working with consultants, and we still will work with consultants until we feel that our permanent capacity is in place, but now is the time to consolidate it under one leader, and so that's Andrew. So congratulations to him on his new role. And that was effective March 1st. Then we've also appointed Chris Deckard as Vice President Copper Operations in Chile. Chris, of course, was in Antamina before he joined us as General Manager at Highland Valley, where he's done a terrific job. And he'll be starting effectively April 1st, which is tomorrow, at the operation to succeed Dave Baree, who will be retiring. I think all of you know what the content of this slide is all about. It's just emphasizing that we are diversified. We're the largest metallurgical or steel-making coal producer in North America, second largest exporter. one of the top 10 copper miners in the Americas, and number 3 mine zinc producer in the world. Going back in time, zinc actually at one stage produced about half of our operating profits in 06, 07. And, you know, I've watched with interest over the last 10 years how we started off, we were a zinc company, and analysts only included us with zinc comparables. Then we became a copper company for 2 or 3 years. Then we became a coal company. And I've always said that at some point we will become a zinc company again. And I believe that maybe it was last quarter, or certainly in a quarter coming soon, that zinc will be the most profitable business unit. And then one day that we will be an energy company. We were an energy company briefly for 2 weeks in December, but I think that was premature. We are focused on the Americas, and we do, though, explore much more broadly. We have either direct grassroots exploration properties or investments in juniors that have activity in a total of about 50 countries that we're keeping track of. But when it comes to significant investments, we're pretty conservative from a geopolitical risk point of view, and quite likely to stay that way. I suspect we have perhaps the lowest overall jurisdictional risk profile of our peer group. Long life assets, of course, are very important to us. I know everybody probably says the same thing, but if you go through our situation, either division by division or asset by asset, the bulk of our portfolio is in very long assets, sometimes up to 100 years. And our new projects that we care the most about are both 50 years as well. And the reason we do that is that you know, the multiple price cycles that you can get from a long life asset make a huge difference to the ultimate return you get on your investment dollar. And I like to sort of project forward and then look backwards and you know, recalculate what the IRR would be if you built in, you know, five cycles in a 50-year time period. And usually the numbers you get are quite significant. Whereas if you have a 12-year asset, as often happens in gold, if you get 4 or 5 bad years in the middle, you never get a chance to catch up. We are diversified from a flexibility point of view in that, while we like the portfolio risk diversification aspect of it, the real reason that we say we're diversified is so that we have a choice as to how to allocate capital. And allocate capital on a risk-reward basis. In that we certainly look at IRR, we certainly look at NPV, and that's the starting point, it's the basic financial discipline. And we then look at it at a full range of metrics of commodity prices or different cost assumptions or CapEx assumptions and the like. One of our key ratios, which a few of you would have heard me talk about before, is mine life to payback. And we want to have a minimum ratio of 3 on mine life to payback, and we prefer to have 4. So for example, if in Fort Hill's case, it took 7 years to recover the capital that we put in, well then we still have 43 years to earn the return. So the mine life to payback in that situation is 7. With QB2, we think the mine life to payback is probably about 10. So, and the reason why that ratio is important is because in all commodities, whether it's copper, zinc, oil, coal, whichever, they're all cyclical, and you tend to get all your capital back in 2 or 3 really good years. You just don't know when those 2 or 3 good years are going to be. They could be like in Antamina's case where it was the first 2 or 3 years after it started up, or it could be like Red Dog's case where it was 15 years before we got our capital back. But if you have 50 years, the odds of getting those 2 or 3 good years 4 or 5 times are much higher. And then again, if you back calculate your IRR after that, then you're likely to have had a very good return for shareholders. So long life assets, mine life to payback, those are kind of related ratios. We're always hoping to be in the low half of the cost curve. We're cognizant that you can't really buy an operating asset that's in the lower quartile of the cost curve. To get one of those, you've got to find it or in some way earn into it or build it. But if you can buy something in the middle of the cost curve and improve it, or in the third quartile, as we did with forwarding. Forwarding was at the 80th percentile on the cost curve, and we took it down to the 40th, and that was sort of the whole reason and strategy behind it. So we're open to looking at things in the third quartile if we have a plan to improve it, to get it down to the midpoint or better. Turning to, as always, the biggest factor affecting commodity markets, and that is China. I was in Beijing, Shanghai, and Hong Kong last week, and attended the China Development Forum, which was hosted by Premier Li Keqiang, and had his key ministers, Lo Jiwei, of course, our old partner from CIC, who was the finance minister, and then the Minister of Commerce, the Governor of the People's Bank, and so on. And it was quite an interesting session because they invited 73 CEOs, mostly the large companies of the world. We were there as a small company, but because of our relationships. And they invite about 20 what they call scholars, which are the top economists of the world, and then people like heads of the IMF and World Bank, Asia Development Bank, and so on. And they lay out their policies and their views of what's going to happen to the economy, not just this year, but for the long term. They're developing their 13th five-year plan right now. They asked for input into that. It won't be published for a while yet, but they're certainly looking at what their goals will be, just as they are trying to finish the goals from the 12th five-year plan to make sure that they've delivered on that. So it was quite interesting. I wouldn't say I came away, as a roaring bull on commodity demand from China. I came away moderately optimistic and confident that in terms of overall growth of the Chinese economy and their targets of around 7%, they are likely to achieve that. They have just so much financial firepower to work with, and they'll likely use it over time. But I think that the shift from fixed asset investment to consumption and services is well underway. As one of the prominent economists noted, economic transformation of any economy is a journey, and on this one, the train has left the station. It's gone a long way to go, but I think they're going to manage it to a soft landing, and but a lot of that's going to be on the consumption and services side, which is good for copper and oil, the consumption-based commodities. Not so bad for zinc. There's no question that they're galvanizing a lot more steel. The galvanizing rates are growing significantly, and as we've always said, that if they ever galvanized steel at even half the rate of the US, that would be demand for another 2 million tons, and they seem to be looking at higher quality cars and moving that direction, so that's positive. It's not so good for steel. Steel does look like the peak, at least what we've been saying for several years, is about 850 million tons. I know BHP and Rio Tinto still say 1 billion and 1.1 billion tons, but certainly with all the customers that I visited in Beijing and Shanghai, 850 looks like more like the number. So that suggests that for increased demand in steel, you'll really be looking to other countries, emerging markets led by India. And then the property market, of course, is key to the extent that housing prices have been declining in, I think, 68 of the 70 major markets. They have certainly taken note of that. You'll have seen in the last 24 hours new policies announced to try to address the property market side of it, including such things as reducing down payment levels from 60% to 40% on second homes and the like. At some point, they'll get a handle on that, but again, we think that it's going to be, much more skewed. GDP growth in China is going to be much more skewed to consumption than fixed asset investment. Having said that, I don't want to sound like I'm overdoing it. The sheer dollar value of the Chinese economy is still growing. Like GDP on percent terms is going down, and what this slide shows is that that in fact the GDP growth in incremental dollars today is double what it was 10 years ago. So when in 2005 growth rate was around 14%, today it's around 7%, but the incremental dollar value is still going up. And the forecast, if it was 7% in 2015, that too would be a slight increase in incremental dollar value. Turning to our diversified business model and key sensitivities, 2/3 of our cash operating profit right now is from base metals, notwithstanding that our trading correlations are more closer to the coal price. 60% coming from copper and 40% from zinc. And these sensitivities are really important to sort of have close to your, well, to the extent you're following us and looking at share price, these are the things that we think should drive the outcome. For every dollar a ton, it's 32 million Canadian of increase in EBITDA, and for every 1 cent a pound in copper, it's $8 million increase in EBITDA. For every 1 cent in zinc, it's 12 million. And then the exchange rate, of course, is the really big one with $52 million EBITDA for every penny. And then I mentioned earlier, for every dollar a barrel, it's $5 million EBITDA. So when we were doing our budgets, and we said, what are the key things we want to accomplish during the year? And one of the things we said is we want to go into 2016 with a minimum $1 billion cash level. And that was important to us because we think as 2016 is the last full year of construction of Fort Hills, and if we're at that level, sometime zinc's going to move, or copper's going to move, or even coal's going to move, and things all kind of will take care of themselves. But if we start with $1 billion, then we wouldn't be touching the credit line, other than if we refinance the $300 million bond that way, until the second half of 2016. So that seemed like a reasonable objective. So we looked then at the base case of $2.60 a pound copper, 95-cent zinc, $65 oil, and a weighted average of $110 coal between the spot sales and the benchmark at that stage. So if you then look at today, well, on copper we're ahead by about 15 cents. So times this 8 million, you'd be ahead by about 120 million of EBITDA. Zinc is about flat, maybe it's down a penny, but we suspect for the whole year it's going to average a lot more than 95. But even if you did it for today at this thing, you'd be down 12 million. So you're still ahead. On coal, we'd be significantly down because coal would, our average, we don't know, we'll see how the third and fourth quarter end up, but say we're down $8 to $10 on that, and that would be 240 or so. But then the exchange rate at 127, we used 120 exchange rate. So 7 times 52 is 350 million. So believe it or not, even though coal prices are down and copper feels like it's down, relative to the budget that we used to get that $1 billion of cash at the end of the year, we're up. We're ahead of that by a couple $100 million. So now we have to execute on the plan operationally, and you know, there's always things that can be challenging there. You could have weaker rail service, for example, from one of your suppliers. But you know, we're confident that we'll be able to execute the plan, and if we deliver on the cost and so on, then meeting that target looks quite achievable at where the commodity prices are currently. Turning to the met coal market, and obviously we've got Ian Kilgar and Rael Foley here who are going to talk about it in this detail, but our belief is that the coal prices are at unsustainable levels. I know we've been saying that, and coal prices continue to decline due to oversupply, but it certainly seems to us that many suppliers are losing a lot of cash, and eventually that cash runs out, though it does always take longer than you think. We think approximately 30 million tons of cutbacks and closures have been announced. I think that number is up to 32.6 or thereabouts. But the implementation has been slow, and certainly more is needed. So we'll just have to keep watching the market. It's clearly weak, and we don't know when it's going to turn. However, current prices in Canadian dollars are, as this chart shows, significantly higher than they were last summer. So even the benchmark price at 109.50 that was negotiated a couple weeks ago is actually $5 Canadian higher than it was 1 quarter before. I'm just going to repeat that. The benchmark price in US dollars of 109.50 that was negotiated 2 weeks ago, in Canadian, well, it's a decline of 7.50 in US dollars. It's an increase of $5 Canadian relative to the previous quarter when that negotiation took place. And of course, our costs are in Canadian dollars. So it may not feel like it, but that's actually how the numbers work. This slide just to show that, you know, in the last 5 years, we have grown production in each of coal and copper and zinc and concentrate and even refined zinc versus what we produced in the year 2010. I know there's a lot of talk about our copper shrinking, but in fact, we're up from 313,000 tons, and we will be up this year versus last year, primarily due to Highland Valley, actually, both where we are in the mine plan and also because of the investment we made in the mill optimization program, which is going very well. We're very, very pleased with that. A couple of comments on Fort Hills economics. We've done sort of two sensitivity analyses, one at $70 WTI and an 80-cent dollar, and one at $90 and a 90-cent dollar. And as you'll see, you know, a number of things change. Like exchange rate makes a big difference, and royalties decrease with decreased price and so on, such that the free cash flow yield at those prices would be 12% at the $70 or 15% at the $90. And we've included a chart there so you can pick your own price and exchange rate and run it down the line just to see. One point to emphasize is that at the sanctioned cash cost that Suncor has given us, you know, even at today's prices, it's positive cash flow. We don't like the payback. It would be a miserable investment, but we actually don't expect oil prices to stay in these ranges forever, though we do think that there's probably a good couple of years down here, at least judging from conversations I've had with the CEO of Saudi Aramco, who I saw on the weekend and previously in January as well. But that, of course, as I mentioned earlier, is good for us for at least the next 3 years. Another way to look at things in terms of our ability to cover the capex related to Fort Hills, what we've done here is shown a chart of what our 2014 free cash flow would have been before the Fort Hills capex and before the dividend. And then we said, what's the adjustment looking forward to 2015 on exchange rate? And at a 126, today it's 127.7, so that would add another 70 or 80 million, but at 126, it's plus 832 million relative to last year. At lower oil prices, it's plus 236 million relative to last year. Lower commodity prices take away about 644, but the net effect is that our free cash flow before Fort Hills and before the dividend would be 713 million. So over the next 3 years, if everything stayed exactly at those things, and remember Canadian dollar is actually even better right now, but you stayed at 126, you would find that we generate 2.1 billion, and that compares to at the beginning of the year we had 2.3 billion of capex to go with Fort Hills. And that, of course, is including full contingency and escalation, and yet we're in a low oil price environment, which we hope to do better. And on top of that, at the beginning of the year, we had $5 billion of liquidity, meaning the $2 billion of cash and the $3 billion US undrawn credit line. So that would suggest that we have 3 times coverage of capital available for the Fort Hills capex, assuming no change in commodity prices from where we are today. So again, and that includes any impact of improved production that we showed in our guidance and improved costs that we showed in our guidance, because we're comparing to last year. And we think we'll do better on both costs and production this year. Though, of course, that remains to be seen. There's 9 months to go. I should remind everybody in terms of cash that in Q1 and to a certain extent Q2, we use more cash because of seasonality in the business and working capital buildup, and then we generate more cash in Q3 and Q4. And if you go back and look at last year, our cash balances were going up in the fourth quarter. So when you look at our cash balance at the end of Q1, build that into your forecast. You don't annualize the decrease in cash. We also pay the dividend in January. We don't pay one in Q2. We pay one in Q3. We don't pay one in Q4. Now, I want to turn to our sustainability strategy for a moment. From working with communities to optimizing energy use to successfully managing water, which is vital, we believe leadership in sustainability is critical to our success and to that of any mining company and to the industry overall. It paves the way for our ability for future project development and for permitting, and while at the same time it satisfies society's needs for the products that mining produces. Now, this belief was the driving force behind the sustainability strategy that we conceived and implemented first in 2011, We identified 6 areas at that time that represent the biggest challenges, and they were the biggest opportunities too in terms of our work in sustainability, and they were communities, our people, water, biodiversity, energy, and material stewardship. And at that time, we set short-term goals for all 6 areas, and importantly, we also set long-term goals looking out as far as 2030. And those targets allow us to continually build on our sustainability performance and to track our progress. And I want to discuss 2 examples right now of the sustainability strategy in action. One strong example, and also a good business practice going hand in hand with that, is our work to improve fuel efficiency and reduce greenhouse gas emissions. Historically, our haul trucks have been left idling during shift changes and breaks for both legacy and maintenance reasons, and also because it's awfully cold sometimes. But focusing on identifying opportunities to reduce emissions, we were able to overcome the maintenance challenges and implement an anti-idling program across all of our mine sites. And last year alone in the Western Canadian operations, the program saved almost 5 million litres of diesel fuel. And importantly, the success of this initiative also speaks to a complete shift in culture, where employees are not only willing, but they are keen to reduce emissions, even if it means having to enter a cold cab in the truck. And similarly, by installing lightweight truck boxes, we've been able to haul more material with each trip, resulting in an efficiency improvement equivalent to reducing diesel by another 1.2 million litres annually. So for these 2 initiatives, diesel savings alone are worth over $6 million per year. And then thanks to these efforts, I'm happy to report that we expect to exceed our short-term goal by the end of this year of 1,000 terajoules of energy reductions and 75 kilotons of CO2 reductions. Now, another example of aligning our sustainability strategy with our approach to business is our commitment to biodiversity. We work in regions that have very high biodiversity values, including Arctic areas, boreal forests, and deserts. And some of these regions support a portion of the world's largest remaining intact areas of natural habitat for important species and biodiversity. And we believe it's essential for us to operate in a manner that avoids impacts wherever possible, minimizes impacts where they can't be avoided, and mitigates their impacts in those affected areas. And that's why last year, in line with our 2015 biodiversity goals, we completed biodiversity management plans at 4 of our operations. And we want to do more than just mitigate impacts. We've charted a vision for ourselves where we want to achieve a net positive impact on biodiversity. And we've seen some success in making that happen. A net positive impact can be defined a number of ways, but it basically means that there'll be more of what was there before. So if there were more salmon or more bighorn sheep, whatever it might be. And for example, in the reclaimed areas surrounding our Cardinal River operation in Alberta, the habitat, the reclaimed areas provide excellent habitat for bighorn sheep. And as a result, the mine is home to the healthiest herd in North America, and we are now actually exporting bighorn sheep to help repopulate the species in a couple of states in the US. So with tongue-in-cheek, I say that that's just part of our diversification strategy. We're in copper, we're in zinc, we're in bighorn sheep. It's not a big revenue source, but it's an important, it's an important activity in the company. And for those of you who have been there, or those of you who haven't been there, I highly encourage you to go to see Cardinal. It is seriously one of the most beautiful mines in the world. I've got pictures on my phone if anybody would like to see them. I actually think they're pretty good pictures. I was hoping they'd get used in our annual report this year, but unfortunately not. We also advanced our goal to offset ecosystem impacts that cannot be fully mitigated or rehabilitated through the purchase of approximately 7,150 hectares of land near our steelmaking coal operations in BC. And our experts in biodiversity are now working with several environmental groups and also with First Nations to manage these lands for the future. So by working together, we've been able to demonstrate that mining can make a positive contribution to habitat conservation. And this helps us to maintain and establish good relationships with communities and stakeholders, a healthy environment, and it ultimately supports ongoing sustainable mining for our company and for the communities. And all of this is linked to permitting and such things as the Elk Valley Water Quality Plan, which was a notable achievement during the year that allows 5 operations to go forward. Our sustainability progress has been recognized by a number of prominent organizations, including those listed here. We were named the top-ranked Canadian company of any company and top mining company worldwide on the Global 100 Most Sustainable Corporations list by the media and investment research firm Corporate Knights, and that was announced at the World Economic Forum. They basically review all companies in the world above $2 billion market value and then choose the top 100. So we were delighted to be the top Canadian company there. We were also ranked in the top 50 corporate citizens, and we were also ranked in the top 50 socially responsible corporations in Canada by Sustainalytics, and then we were recognized by the Globe Foundation and the PDAC as well. We were named to the Dow Jones Sustainability World Index for the 5th consecutive year, indicating that Teck's sustainability practices rank in the top 10% of the 2,500 largest companies in the S&P Broad Market Index. And while we know we have more work to do, I do believe that these achievements suggest that we're going in the right direction. So in summary, we are focused on executing our long-term strategy, which has not changed. We believe we are well positioned for commodity markets when they improve. We are benefiting from those low oil prices and also the weak Canadian dollar. We're focused on controlling what we can control, and we're building an energy business that we think will be very strong economics for a 50-year mine life. And last but not least, a strong financial position and a stable investment grade credit rating. So I was just consulting with Greg before getting up here. I'm willing to take a couple of questions, but we have all of our key people here, and I'd really rather, like for some of the questions, have them answer them, because you don't get to see them that often. You get to see me quite a bit, and they're the experts, and I really want to give them a chance as well. So I'm willing to take a couple sort of big picture questions right now, but you might find that I want to defer some of them to our key team members. So with that, open it up.
So if you have a question, raise your hand and we'll get you the mic to get it on the record.
Hey, Greg.
Don, it has to be asked. M&A, obviously the rumors yesterday. What are your characteristics? What are the things you're looking for in a copper asset or not? Scale, big transformative M&A or not?
Yeah. So fair question. What I want to draw your attention to is the second sentence of the short press release that we issued, and that was that there were no corporate development, broadly speaking, activities that we are aware of, or that I was aware of, that would affect share price as we saw yesterday in the markets. So that was meant to include a bunch of things that we've seen written. That yesterday was Antofagasta, last week there was a Hudbay one, Zaldivar has been mentioned. There's a whole bunch of things that we've seen where Teck is rumored to be doing this or that. We suspect those rumors will carry on, but at this stage there's nothing that I'm aware of that should drive share price like it did yesterday. So that's very important. But to the second part of your question, I have been quite public that we think copper has good prospects in the medium term. We've always thought that 2015 was going to be the weakest year. It looks like it's not going to be as weak, perhaps, as we had thought. And I think Andrew's going to talk about this in more detail later. But briefly, we think the surplus, which was originally going to be 600,000 or 700,000 tons, is probably down to about 100,000 tons, which is pretty close to balance. We think global demand is still pretty steady, and we think it's very, very tough to bring on new supply. We've experienced that ourselves, and I think there's about a dozen projects in Chile, as an example, that are having a tough time moving forward. So to the extent that we get through into 2016, second half of 2016 and 17, 18 and so on, we think there's going to be a significant period of time, 4 or 5 years or longer, when copper is in a structural deficit. And so if we could buy an operating asset for a reasonable price, that'd be something that we'd be interested in. And I think it was quoted that I thought something might shake loose towards the end of the year. I don't know. We're probably just being hopeful. But we're tracking things pretty closely. Every deal that has happened in the last couple of years, you can assume we looked at it. That's our job. Andrew Golding and his team, that's what they're paid to do, is to be on top of all these things. and at some stage, hopefully, we'll do something. But to this point, nothing has met sort of the criteria. And a lot of times, the criteria, remember this mine life to payback ratio? This is quite important to myself. My chairman is the guy who originally came up with it, so it's very important to him. So that's a kind of a quality measure, building for the long term. And so most of the things that have come up don't really measure up on that ratio. So all the other things, I think you know the general criteria we've been through before. Does that answer? Okay. Fair question. Any others? Okay, with that, I'll turn it back to Greg.